So the uncomfortable feeling that you guys have right now is because you can't determine the value of something because the government basically removed the ability to truly price assets.
Do you see real estate slowing and coming down with its prices this year?
No.
Why?
Printing money and money flowing through the system, it's like an iceberg. You're only seeing the tip. When that iceberg comes and hits, it's gonna be significant. You're only seeing the tip of the inflation. Now, you printed 25% of the money. There's gonna be significant rollout if you increase the money supply 25%. One, when the money goes through the banking system and it goes from there and then out through the system, it has like a 7 to 10 multiple. So we didn't just increase 25%. We have a 7 to 10 multiple on that if it fully all flows through our banking system. And then if it leaves our country and goes through other countries, those other countries, they also have the opportunity when it goes through their banking system to have multiples on that money. And then when it comes back into our country, it can go back into our banking system. So it could be even more than 7 and 10 by the magnitude of the money moving. So when they print money, it is a huge tsunami wave that's coming through. And the amount of money that they printed is greater than they ever had in history and for this one point in time. You add that on top of a standard loan, a commercial loan is like 30% down. So then we have another a 3x on top of that. So we got 25% increase in our money supply. Then we got the movement, let's just say it's a simple 10x on that. So then we have this really a 250x multiple on the market. And then we have a 3-to-1 loan ratio on debt. So we're talking about the potential of real estate prices are, I think, in the next 10 years, we'll have a very, very good chance of tripling. We're talking about tripling in the next 10 years. Good chance. Now, this is not them increasing interest rates to 8%, right? If they jack interest rates to 8%, obviously that's going to slow things down.
Interest rates on loans?
That is the base for the money. And then every other loan is going to increase based off of that base. So all loans would increase, yes. And then interest rates on loans go up, that means interest rates on CDs go up as well. So when interest goes up, it goes up everywhere. If that happens, it's going to reduce inflation. But I still think the amount of money they printed, they're stuck with not able to escape printing more money. So even if they increase interest rate, they're probably still going to be stuck with increasing the money supply. When they printed 25% extra money into our system, or additional money into our system, that changed everything. That crash of the housing market, because of all of these properties coming to the market, is unlikely to happen right now. Because when you have all this cash, it has to go to something tangible. It has to go somewhere. And what's going to happen is there's going to be all this money. Like, I have a ton of money right now. What am I going to do with it? I can only do so much with it, right? So what am I doing? I'm buying more properties. And now all these companies and hedge funds, they're buying stocks and bonds, they're buying all this different stuff. They're coming to the point, they're like, wow, all this stuff is overpriced. What's still reasonably priced? Real estate. When you cannot truly tell what the value of something is, it becomes so uncomfortable. So the uncomfortable feeling that you guys have right now is because you can't determine the value of something because the government basically removed the ability to truly price assets. And how did that happen is because now with our fiat currency, it was not pegged to anything. Two, they printed a massive amount of money. So you're going to feel like this is very hard to measure it to compare to something else. So if you think of it this way, they increased the money supply roughly 25%. So if we had a flat gold standard on the money supply, what that would mean in a vacuum scenario, if you had money based off of a gold standard or on a hard money standard without the banking system multiples that I mentioned earlier, when you increase 25% of money supply, everything costs 25% more. Now, on top of that, they lowered interest rates, which makes money cheaper and the monthly payments lower. Everybody buys something based off of the monthly payment, or most people do. So if someone can afford a $2,000 monthly payment and interest rates drop, now they can afford a larger purchase because the interest rates are lower, so they can afford more home. The payments are lower. So given that, people are going to be able to afford to pay more for a house because of these interest rates. That causes prices to go up even more. So 25% last year, 22 to 23% this year, roughly 18 to 20% next year, 15% the year after that is my estimate. This is my estimate based off of interest rates going the way they stated they're going to go, where they're going to have a small increase every year. If they have a major increase, then obviously the numbers will have to change. If you also remember, I told you guys this. I said in the future, we're going to have loans at 2%, 1% home loans. We're going to have even a 0.5% home loan. When I gave you that, it was basing the inflation off of 2%, because what happens is there's an inflation rate and then an interest rate. So at some point, interest is going to be like lower than the inflation rate. Well, that estimate that I told you guys about, that vision that I had that's going to happen for our future, isn't happening in 10 years or 20 years. It's happening today. And how it's happening today is that when I was estimating a 2% inflation rate and a 0.5% mortgage rate, where a 1.5% difference, they're basically loaning money cheaper than what the inflation rate is. Well, today, our inflation is estimated to be at 7%. The CPI is around 6.7, 7%. Our interest rate's at 3% for a home loan. So our interest rates are already negative 4 points. We already at the 20-year number. We're going to see hyperinflation in asset prices, specifically housing and any type of commodity that we need to use to sustain, to live off of. It's going to be very hard because it's tricky to see that we need to spend our money. We need to be able to buy stuff that's worth it, because the biggest risk you run into, especially if you have a significant amount of cash, is that you're going to wait on the sidelines and you're going to realize that your $100,000 in a year is worth 20% less, and another year is another 20% less, and in 3 to 4 years, your 100 grand is only going to buy you roughly like 50 to 60 grand worth of stuff. So you almost take on a bigger risk waiting on the sidelines. I am the person that measures things off of probability. 10% chance of this happening, 30, 40, 50% chance of this happening. There is like a 15% chance that they jack interest rates very high, meaning they increase interest rates not 25% every 6 months. There's a chance that they can increase interest rates 1 to 2% in a year, push us to 7% interest compared to the current Fed rates, like around 3 right now. If you're buying any piece of real estate and you're going to own it over 7 years, then it doesn't matter what happens today to 7 years from now, because any gap, any bounce, increase or decrease in the price won't matter, because you're not going to notice it. You're going to buy and live in that property. For example, I met with one of my clients today for lunch. He said he's paying $1,500 a month for a 1-bedroom. He's planning to buy a 3-bedroom townhouse for like $400,000. The monthly payment of it is going to be roughly $1,500. Hypothetically, interest rates increase, housing prices drop, his payment is going to be about the same. In that scenario, by the time 7 to 10 years comes, everything came back. Same reason I told everyone in 08, 09, I said, why are you giving up your properties? It's going to come back. You can't have prices this cheap. It's cheaper than what it costs to build. Do I think that's going to happen again? Unlikely. Unless we have a banking crisis. And interest rates going up is not a banking crisis. We're talking about secondary markets, governments not buying mortgages, secondary markets not buying mortgages. That's not going to happen. If interest rates go up and we're now offering these mortgages on higher interest rates, very likely everyone's going to be buying those mortgages, because they're not going to want these loans at 3%. They're going to want to buy all these mortgages that are 6, 7%, because, hey, Inflation 6-7%. I got a loan at 6-7%. I'm breaking even. I'm not talking about John Doe that lives down the street. I'm talking about the companies and these hedge funds that have billions and trillions of dollars. They're gonna buy up all these loans, so the secondary market should still be strong.
So point blank today, just if you've been wanting to buy your home, if you're, like, do the cost average.
Buy quality.